Not all income is created equal. You can work hard, earn a great living, and still end up broke in retirement, or worse, with a lot of income that the IRS gets their hands into. Most high income earners, doctors, dentists, they're all saving in the traditional places, 401k, brokerage accounts, maybe even a Roth if they can swing it. But here's the problem. It's not just about how much you earn, because that's what most people are just focused on, how much we can earn. It's about kind of income you can keep. Because if you don't plan ahead, taxes are going to quietly eat your future alive. And in this video, I'm going to show you the 5 types of income that can help you keep more, owe less, and build true financial freedom before you turn old and gray. These are the strategies that I've used and I continue to use personally, and most of them you can start right now. First up is this, Roth IRA distributions. If you follow the rules and you wait until you're 59 and a half, your withdrawals are going to be tax-free. That's huge, especially when you compare it to a traditional IRA or like a 401k, something like that, where every dollar gets taxed as ordinary income. For high earners, especially if you expect taxes to go up in the future, which most do, this is a no-brainer. And if you've already phased out of contributing directly to a Roth, well, simply look into the backdoor Roth conversion strategy. Just make sure that your CPA knows what they're doing. Moving on to number 2, and this is one of the most overlooked ones in my opinion, and that is this, the health savings account. I actually call this the stealth wealth account, and if you're somebody that makes a lot of money, this really should be part of your playbook. It actually gives you a triple tax benefit. Number 1, you get a tax deduction whenever you contribute to the account. Number 2, when it's in the account, it's growing tax-free. And number 3, when you actually use it for qualified medical expenses, your withdrawals are tax-free as well. But here's where most people miss, and this is where it gets a little bit fun. Let's say you spend $1,000, all right, out of pocket for some sort of procedure this year. Let's say you have to have a root canal done, okay? But you don't reimburse yourself. You don't take the money out of the HSA. Instead, you just pay for it with a credit card or whatever. And instead, you leave that $1,000 in the HSA, you leave it invested, and now it's growing, compounding growth. We have ours in Vanguard index funds. You could have them in whatever you want. And here's the thing, there's really no time limit when you can reimburse yourself for that procedure. Let's say 10 years from now, you wait and then you decide to take that $1,000 out. You take it out, it's tax-free, all right? And here's the thing, you could say, okay, you remember that root canal I had done 10 years ago? Now I'm reimbursing myself. Again, that money's tax-free. You never used it for the expense back then because you're still working, you're still making money, you didn't really need to. You'd rather it grow tax-free. So it's like getting a tax-free paycheck later in the future. And if you never need it for medical expenses to begin with, once you turn 65, you can actually treat the HSA just like a traditional IRA. Your withdrawals, yes, they'll be taxed, but there's no penalty. It's the most flexible account most high income earners overlook, and it's really perfect for us, like myself and probably like you, that are already paying out of pocket for medical care. Number 3 is the home sale capital gains exclusion, especially if you're thinking about downsizing. So we're going to talk about, we can just say this is tax-free profit whenever you sell your home. Let me explain. If you're somebody, maybe you live in a big house right now and you're planning on downsizing in the next few years or as you near retirement, this one can be a big win, because when you sell your primary residence, the IRS actually lets you exclude up to $250,000 in capital gains if you're single, and up to $500,000 of capital gains if you're married filing jointly. This is big. All right, what does this mean? Well, this means that you could sell your home and you could walk away with up to $500,000 profit and you pay 0 tax on it. It's actually one of the few chances in your life where you're actually going to get to unlock equity in your house you've been living in completely tax-free. But here's the catch, and it's an important one. You must have lived in your home at least 2 of the last 5 years as your primary residence. If you're in a big home with more space than you need, or maybe you're thinking about moving closer to family, or maybe you just want to relocate for lifestyle reasons, you want to get closer to the beach or the mountains or wherever, this is a real strategic way to shift into a lower cost home and pocket tax-free cash. It's not about where you live, it's about using real estate to build liquidity without the IRS tagging along. Number 4, my absolute favorite, and if you follow me on these videos, you will know this one very well, and this is passive income. I'm not just talking about set it and forget it stock portfolios. I mean income that shows up in your account without you having to clock in. For high income earners, the most powerful passive income sources, in my opinion, and my favorite one, is real estate syndications. This is a group investment. You invest in large deals with a group alongside others. You also have rental properties. This could be single family homes, multifamily, short-term rentals, self-storage, things like that. For all you stock market people, you have dividend paying stocks. You can also have REITs, and you can also have passive income from business income. But here's the thing, with the business income, this could be from companies that you own, but you don't run day to day. What is the key to all of these? Well, the key is this: you're not trading your valuable time for money. Now, let's go a little bit deeper on my favorite investment, real estate syndications, for a minute, because that's what's got me to the point that work is optional as a periodontist, as a dentist. In a syndication, you invest passively in some sort of property. My favorite, mobile home parks and RV parks, but you can pretty much do it in any type of real estate. You get cash flow from that every quarter or every month. But here's the best part. Thanks to something called bonus depreciation, the majority of that income is completely offset on paper. So you're getting paid, but your K-1 tax form may show little or even a huge paper loss. That's the tax code working in your favor. That's why syndications are a go-to for doctors, dentists, attorneys, people like that. People looking to build wealth without piling on more work, without me seeing more patients, without you seeing more patients, customers, clients, whatever. Rentals and these other passive income streams, they can do this too, especially when you pair them with smart tax planning. But syndications, they offer scale, diversification, and really true hands-off cash flow. And this is how I actually started replacing my dental practice income, not by saving more in a 401k or a savings account or whatever, which I still have a 401k, but it's by shifting how I'm earning money. And last but not least income, and this is really next level, which actually pairs with the real estate syndications, something called a cash out refinance. Cash out refinance. Or imagine this: you invest $100,000 into one of our RV park or mobile home park syndications. Property appreciates, it goes up in value, it gets improved. 2 or 3 years later, we send you back your entire investment, your entire $100,000. But here's the kicker: that money that we just gave back to you, it's not taxed. Why? Because the IRS actually treats it as a loan, not income. You're actually borrowing against equity. You're not selling anything, right? Meanwhile, here's the kicker: you still own a share of that RV park or mobile home park, and it's still producing cash flow to you. It's like getting your investment back without ever selling the asset. This is how the wealthy keep compounding money without getting hit by capital gains or income tax every single year. And if you combine this passive income from syndications, you can really build some serious momentum fast. If you're a high earner and you're really serious about building tax efficient income as you're getting closer to retirement, that'll work even while you sleep, these 5 strategies are just the beginning. And if you want to learn more about my favorite passive income investment, it's actually the one that's helped me replace my clinical income and get to the point that work is optional. I have a video about real estate syndication where I break down how they work, why they're so powerful, and how you can get started even if you don't have time to be a landlord. You don't need more hours, you just need better income. And this may be the best place to start. Want to learn more? Watch this.